Welcome to the Deep Dive. Today, we're plunging into a topic that, well, it truly touches the very core of human aspiration and cutting-edge medical science. It's a profound truth that so many couples dream of starting a family, yet that path can be incredibly challenging. Did you know that approximately 1 in 6 adults globally are affected by infertility?
1 in 6. That's a staggering statistic.
It really is. It impacts millions of lives and fuels an entire vital industry dedicated to helping people fulfill that dream, the dream of having a healthy baby.
Absolutely. A fundamental human desire.
And that's exactly where our deep dive takes us today, into the world of Vitrolife AB. This isn't just another medical device company.
No, far from it.
It's a Swedish powerhouse
Yeah.
that's a global leader in assisted reproductive technology, or RT. We've taken a comprehensive investment analysis, really dug into the numbers, the science, the strategy, and we're going to pull back the curtain on this fascinating, complex business for you.
Yeah, there's a lot to unpack there.
Our mission, for you, the listener, is to understand not just what Vitrolife does day to day, but the intricate web of forces shaping its future. We'll explore its powerful market position, the cutting-edge science, its pioneering, definitely.
And the significant financial headwinds it's currently battling, that's crucial too.
Exactly. We're truly looking to unravel that core tension between its undeniable long-term potential, driven by these fundamental human needs, and its more immediate short-term challenges that are, frankly, impacting its bottom line right now.
It's a classic business story in many ways. Innovation versus current market reality.
We're going to unpack everything, from their specialized medical devices and advanced genetic testing to their ambitious pivot into a fully integrated digital platform. It's a compelling story of innovation, market dynamics, and that delicate balance between aggressive growth and maintaining profitability in a highly sensitive field.
Delicate is the right word.
So let's get started and explore what makes Vitrolife tick. Okay, let's unpack this. When we talk about Vitrolife, who exactly are we talking about? It's a company with a history, right? Stretching back to 1994, headquartered in Gothenburg, Sweden.
That's right, Gothenburg. And what started as perhaps a more niche player has quietly grown into a true behemoth in its field. It really touches countless lives around the world now.
And their mission seems quite central to how they operate.
What's truly fascinating here, and I think it defines their entire approach, is their stated mission to be the leading global partner in reproductive health. And they have this very clear vision to enable people to fulfill the dream of having a healthy baby.
So it's not just about selling widgets.
Not at all. They're not simply manufacturing and selling products. They're explicitly aiming to facilitate one of the most profound human desires. This mission, you feel it permeates their culture, their product development. It gives their work a deeply personal resonance.
And they've certainly achieved global scale. You mentioned their reach.
Oh, absolutely. They serve an estimated 75% of all fertility clinics worldwide across roughly 125 markets.
75%. Wow.
Yeah. That's an astonishing footprint. It's achieved through a mix, really. Direct sales teams in key regions, and then an extensive network of distributors reaching further afield. This isn't just about market share. It means a vast number of fertility journeys globally rely in some way on Vitrolife's technology.
Wow, 75% of all fertility clinics globally. That's an incredible reach, and it really speaks to the trust they must have built. But what really makes them stand out, beyond just market share, is their unique position across the entire assisted reproductive technology, or RT, value chain. The report we're diving into calls it an unbroken chain of solutions. What does that phrase truly mean in practice for the clinics and ultimately for the patients going through this deeply personal process?
That concept of the unbroken chain, it's absolutely central to their competitive advantage. It means Vitrolife covers nearly every critical step of a clinical IVF workflow. It makes them an indispensable kind of single-source partner for many clinics.
So walk us through that chain.
Well, think about it. It starts with something as fundamental as the specialized needles used to gently collect a woman's eggs during oocyte retrieval. Very delicate.
Right.
From there, it moves through crucial steps like gamete preparation and fertilization, all done with their proprietary nutrient-rich culture media specifically designed for optimal cell health.
The stuff the embryos grow in.
Exactly. Then it's about embryo culture and selection. utilizing their advanced incubators, powerful AI software for, objective assessment, and highly precise genetic testing.
All the way through.
All the way, right through to embryo transfer, often using specialized catheters and media like embryo glue, which can actually enhance implantation rates. And finally, cryopreservation, freezing surplus gametes and embryos for future use.
So it's truly end-to-end.
It is, and this end-to-end model is incredibly powerful because it creates remarkably sticky customer relationships. Clinics invest heavily in training their embryologists, their scientists, right? They validate their protocols around specific products.
Makes sense. Consistency is key.
Totally. Using a single vendor for an entire workflow means seamless compatibility, consistent quality, a simplified supply chain, all invaluable in a high-stakes, time-sensitive environment like IVF. It's a significant de-risking factor for clinics. They know the parts work together.
So it's not just about selling one great product, but building an entire integrated ecosystem where everything works together. And that sounds like it must create powerful cross-selling opportunities for Vitrolife.
Oh, definitely.
Is this where that classic razor and blade business model really comes into play? Selling the main equipment drives recurring sales of the consumables?
Precisely. That's exactly the model. The sale of their capital equipment, like their flagship EmbryoScope time-lapse incubator, effectively acts as the razor.
The big ticket item.
Right. A significant upfront investment for a clinic, establishing that crucial installed base. Once that razor is in place, it then drives recurring, high-margin sales of their proprietary consumables. Those are the blades.
Like the media, the dishes.
Exactly. The specialized culture media, cryopreservation solutions, even software licenses for their AI tools like IDA-Score, all designed to work optimally with their capital equipment. This creates a powerful recurring revenue stream, high margins.
But you mentioned vulnerabilities.
Yeah, it's not without its vulnerabilities.
Great.
We're starting to see signs that this synergistic model can be impacted. Recent slowdowns in capital equipment sales, particularly in regions like APAC, can have a ripple effect.
So if they don't sell the razor...
Then the future blade sales are impacted.
Exactly.
If clinics are postponing purchasing new embryoscopes, that directly translates to fewer opportunities for new recurring media and software revenue down the line. Even if existing customers keep buying consumables for their current equipment, the initial razor sale sets the pace, and any hesitation there can create a lag effect on the blades.
That makes a lot of sense. A classic business model with a classic vulnerability, especially, I guess, in uncertain economic times. Let's break down their business into its three main segments. They generated, what was it, SEK $3,609 million in net sales in fiscal year 2024. Let's start with consumables. That really seems like the consistent backbone of their revenue. This segment, to me, sounds like the bedrock. Pulling in SEK $1,384 million in FY 2024, these are the disposable products, the ones absolutely essential for every single IVF cycle. Things like those nutrient-rich culture media, cryopreservation solutions, all the specialized labware like dishes and pipettes. It's the stuff clinics just can't do without cycle after cycle.
You're absolutely right. Consumables are indeed the bedrock. And what's particularly significant about this segment is its remarkable resilience. It achieved 10% organic growth in 2024.
10% solid.
Very solid. And it continued that strong momentum with 9% organic growth in Q2 2025. This consistent demand, even when other segments show weakness, seems to be primarily driven by Vitrolife's market share gains.
So they're actively taking share.
It appears so. They're taking share from competitors, which is a powerful indicator. It shows the non-discretionary nature of these products. Clinics must buy them for every cycle. And Vitrolife's strong competitive position, likely due to that integrated system and brand reputation we talked about.
So even if budgets tighten elsewhere,
they still need the high-quality media and disposables to ensure the best possible outcomes. It makes consumables a highly stable and predictable revenue stream for them.
Then we have technologies at SEK $730 million in FY 2024. This is where their flagship capital equipment lives, like the EmbryoScope time-lapse incubator alongside that cutting-edge AI software like IDA-Score for embryo selection, and even specialized laser systems for things like embryo biopsy.
Sounds like the engine room of their innovation.
It absolutely is. And it's also where you see more cyclicality. Sales and technologies are tied more closely to clinic budget cycles, their expansion plans, their overall willingness to invest in those big-ticket, high-tech items.
Makes sense. More variability.
Exactly. Well, it saw robust 16% organic growth in 2024, which was impressive. 16% is strong.
Very strong. But we've observed a weakening performance more recently in Q2 2025, particularly in the Asia-Pacific APAC region. Clinics, there seem to be postponing capital expenditures due to, lingering economic uncertainty.
Affecting their willingness to make those big investments.
Right. This directly impacts the razor sales we discussed, illustrating how even a strong, innovative product line can be affected by broader economic conditions and clinic-level financial caution. It's critical for future growth, but also the most sensitive to those macroeconomic shifts.
And here's where it gets really interesting and perhaps a bit more challenging for Vitrolife, the genetics segment. This actually became their largest segment, didn't it? SEK 1,495 million in FY 2024.
That's right, largely due to their significant 2021 acquisition of Igenomics, a major player in reproductive genetics.
And this segment offers crucial testing, like PGTA for chromosomal abnormalities, and that endometrial receptivity analysis, the ERA test, right, helping pinpoint the best time for embryo transfer.
Correct. These are powerful tools aiming to boost success rates. However, despite its size and the strategic importance Vitrolife placed on it with the Igenomics acquisition, genetics has been a persistent source of weakness for the company lately.
Weakness, even though it's the biggest segment.
Yeah, it actually contracted 5% organically in 2024. There were specific issues mentioned with genomic kits, the consumables used for the tests, and continued struggles with the ERA test. Maybe market adoption challenges or efficacy questions or headwinds there.
And those struggles continued.
Unfortunately, yes. Continued into 2025, and they were further hampered by severe geopolitical instability in the Middle East.
Ah, a key market for those services.
A very key market for these specific genetic services, often due to cultural or familial factors making pre-implantation genetic testing particularly sought after. So this raises an important question for Vitrolife and its investors. What is the true long-term value and integration success of such a significant acquisition if it continues to be a drag on overall performance?
Right. The expectation was clearly for this to be a major growth driver.
Exactly. Adding a vital new dimension to their unbroken chain. Its underperformance is a significant concern, both operationally and financially.
So we've outlined Vitrolife's foundational offerings and its comprehensive reach. Now let's zoom out a bit. Let's turn our attention to the broader canvas it operates on, the global assisted reproductive technology market. What's driving this immense and growing industry? What's its overall trajectory looking like?
Well, the market is indeed large, and it's structurally growing, driven by fundamental and, frankly, deeply personal demographic shifts. Now, the exact estimates vary across different market research firms.
Always the case with market sizing, isn't it?
Always. For instance, Grandview Research projected $25.7 billion in 2022. Growing to maybe $41.4 billion by 2030. That's around a 6% compound annual growth rate, or CAGR. Precedence Research was more bullish, seeing it closer to $31.6 billion in 2024, maybe hitting $80.5 billion by 2034. That's almost 10% CAGR. GM Insights is somewhere in between, maybe 7% CAGR.
So the numbers vary, but the direction is clear.
The consistent theme across all of them is robust, mid to high, single-digit annual growth. This isn't a fleeting trend, it's a long-term, powerful force. Even a small difference in that CAGR translates to billions in market size over time.
And what's fueling that consistent growth?
Several critical market drivers. Firstly, there are undeniable demographic imperatives. The rising prevalence of infertility, that WHO estimate of 1 in 6 adults globally, is a massive factor.
Huge underlying need.
Huge. And this isn't just statistics. It reflects millions of individuals and couples facing a profound personal struggle. This challenge is further compounded by trends like the increasing average age of first-time parents across many developed nations.
Which naturally impacts fertility.
Correct. And lifestyle factors too, like rising obesity rates, which are also known to negatively impact reproductive health.
Okay, so demographics is one major driver. What else?
Secondly, there's expanding access and growing social acceptance. RT is increasingly seen not as some last resort, but as a standard, legitimate medical treatment for infertility.
Less stigma attached now.
Definitely. That shift in perception is significant. Furthermore, the evolution of modern family structures arise in single-parent households. Increasing use of RT by same-sex couples is dramatically expanding the total addressable market beyond traditional patient demographics.
Opening it up to more people.
Exactly. This reflects a profound societal shift in how families are formed, making art even more central. And thirdly, continuous technological advancement is constantly improving outcomes and driving demand.
Better results mean more demand.
Absolutely. Ongoing innovations in and pre-implantation genetic testing, like PGTA screening for chromosomal abnormalities, often linked to failures, breakthroughs in time-lapse imaging, AI, and embryo selection. These advancements make art more effective, safer, more accessible. It fuels growth by offering better success rates and, frankly, greater hope.
It sounds like an incredibly compelling market to be in, with those kinds of fundamental tailwinds. But, no market is without competition. Who are they actually up against? Is it a crowded field, or are there just a few dominant players alongside Vitrolife?
It's a market that is fragmented, meaning lots of players, but with some very large, well-established players at the top. Cooper Surgical, which is a division of the U.S. company Cooper Companies, is arguably Vitrolife's most direct and formidable competitor.
They offer similar stuff.
Very similar comprehensive portfolio of fertility and women's health products. They often compete head-to-head. Then you have Fujifilm, Irvine Scientific, strong particularly in cell culture media for IVF. Cook Medical provides essential devices like catheters, oocyte retrieval needles.
And smaller players, too.
Yeah, smaller, more specialized players like Hamilton Thorne, focusing on precision lasers, imaging for embryology labs, and importantly, the end market itself, the fertility clinics, is consolidating. Larger clinic chains are emerging.
Which means those customers have more buying power.
Exactly. Consolidation increases the purchasing power of these bigger customer groups. So Vitrolife has to be very attuned to negotiating power and providing those integrated solutions that appeal to larger, more sophisticated buyers.
So in this competitive landscape, what makes Vitrolife special? What are their moats, as we like to say in the investment world? What protects their business and gives them that durable edge against these very competitors?
They indeed have several strong moats protecting their business. First, I'd say, is their technological leadership. They are the undisputed global leader in time-lapse incubation. Their EmbryoScope system, for example.
We talked about that earlier.
Right. It's used in an estimated 25% of all IVF cycles globally. That's staggering.
A quarter of all cycles.
Yeah. And it's not just an incubator, it's state-of-the-art. Records embryo development in real time, lets embryologists select the best embryos without removing them from their optimal environment. That's huge for success rates.
Yeah.
And that installed base creates a powerful lock-in, driving those recurring sales of compatible consumables and software. Makes it incredibly difficult for clinics to switch.
Okay, so technological leadership is one. What else?
Second is their brand reputation and quality. In reproductive medicine, outcomes are everything. Patients, clinics, they demand the highest quality, the highest consistency, because the stakes are profoundly high.
You can't afford mistakes.
Absolutely not. Vitrolife has built an incredibly strong brand on this, backed by rigorous quality control, all the necessary regulatory approvals, CE marks in Europe, FDA clearance in the US. Their Net Promoter Score, they reported 53 in 2024. That's quantitative evidence of strong customer loyalty. Customers are highly likely to recommend them.
That's a solid score. Third moat.
Third, their integrated portfolio and high switching costs. As we discussed, that end-to-end solution creates very sticky relationships. Imagine a clinic trying to switch from Vitrolife.
Big undertaking.
Huge. Retrain staff, revalidate numerous protocols, potentially manage multiple new vendors. The perceived risk of disrupting successful patient outcomes, plus the actual cost and time involved in validating new products, makes the cost and hassle of switching substantial. They become incredibly difficult to dislodge once embedded in a clinic's workflow.
Makes sense.
And finally, there are high barriers to entry. The RD industry has stringent and complex regulatory hurdles. For example, the new European Medical Device Regulation, MDR.
Heard about that. It's tough.
Very tough. It's significantly tightened requirements across the EU. It's a multi-year, multi-million-euro gauntlet for any newcomer just to get a product to market. You need extensive clinical data. You need to build trust in a conservative, risk-averse clinical community. These are all high hurdles, effectively preserving the incumbents' positions.
So those regulations help keep competitors out?
They do, but that regulatory framework, while a protective moat, is also a double-edged sword. While it deters new entrants, it introduces significant operational complexity for Vitrolife itself. Regulations vary widely by country. PGTA, for example, that key genetic test, not allowed in major markets like Germany or France. You need highly customized commercial strategy.
I see. Adds complexity.
And the political landscape can create sudden market shocks. We saw this with the uncertainty generated by the U.S. IVF executive order in early 2025.
Right. You mentioned that impact.
Yeah. Even without formal legislative changes, the discourse alone immediately impacted IVF cycle volumes as patients and clinics got cautious. It had a real, immediate impact on revenue in the Americas. This makes their revenue streams potentially less predictable than in, say, more globally harmonized environments.
It certainly sounds like a robust business, strong fundamentals, solid moats. But as you said, the report also highlights some significant challenges Vitrolife is facing. Created some choppy waters for them recently. Let's talk about their recent financial performance, especially in the last year or so. How are those headwinds impacting the numbers?
Well, Vitrolife certainly has a strong history of growth, no doubt, driven by both organic expansion and those strategic acquisitions like Igenomix. Total group sales grew robustly from, SEK 1,246 million in 2020 to SEK 3,609 million in 2024.
That includes the big Igenomix jump in 2021.
Exactly. That acquisition significantly expanded their footprint into genetics and nearly doubled the company size at the time.
That's impressive historical growth. But looking at the more recent past, 2024 saw only, 3% recorded growth in SEK, though 4% organically, stripping out currency.
Right, a modest year in reported terms.
And the first half of 2025, even tougher it sounds like. Total sales actually declining 4% in reported SEK, leading to flat organic growth year over year. Or maybe 3% if you exclude discontinued activities. That suggests a notable slowdown, doesn't it?
It definitely suggests a slowdown in momentum and a real challenge in translating that underlying business activity into the reported financial results. The currency impact is significant there.
And what about profitability? That's often where the story gets interesting.
Here's where it gets particularly important and maybe concerning. Their profitability trends. Their gross margin actually showed improvement, rising from 56.3% in FY 2023 to 59.3% in FY 2024. That suggested good operational efficiency, maybe favorable product mix.
Okay, so gross margin was improving.
But that positive trend unfortunately reversed in Q2 2025. It contracted back down to 58.0%. Management pointed mainly to negative currency effects, translating foreign sales back into a stronger Swedish krona, reduces their value, and a slight but noticeable increase in supply chain costs.
Okay, a dip in gross margin. But the really critical metric, the EBITDA margin, they have that long-term target over 33%, right?
Correct. Over 33% is the goal.
But it's fallen dramatically. It hit 34.0% in FY 2024, so above target then, but then collapsed to 27.8% in Q2 2025.
Yeah, a sharp drop.
That's nearly 700 basis points in just a year. That seems like a serious concern for any company, especially one that historically commanded a premium valuation partly on the strength of its profitability. How do we make sense of such a sharp drop?
Well, this severe compression isn't just due to external factors like currency, though that's a huge component. As a Swedish company reporting in SEK, a strengthening krona just hammers reported profits from foreign markets.
Right, unavoidable to some extent.
But it's compounded by those lower gross margins we just mentioned, and importantly, a significant 6% increase in operating expenses.
So costs are up too. Why?
These increased expenses are largely due to planned strategic investments, particularly in their U.S. commercial organization building out a bigger sales and marketing presence there. Plus, higher administrative costs that come with running a larger, more complex global business.
Oh, planned spending.
Planned spending, yes. But it raises that important question for investors. Is this a temporary investment-led decline that will ultimately fuel future growth and a rebound in margins? Or is it something more fundamental, a deterioration in operational leverage, cost discipline, suggesting maybe a new, lower baseline for profitability? It's a crucial distinction to make.
How about net income?
Looking at net income, it recovered to SEK 514 million in FY 2024. That was a significant bounce back from a massive SEK 3,851 million net loss in FY 2023.
A huge loss in 2023. What caused that?
That 2023 loss, however, was heavily distorted. It was due to a one-time, non-cash SEK 4,300 million impairment charge related to the Igenomix acquisition.
Impairment charge, meaning they wrote down the value.
Exactly. An impairment charge signifies that the acquired asset Igenomix is now valued less on the balance sheet than what was originally paid. It effectively acknowledges that the acquisition hasn't generated the expected value, at least not yet. So that 2023 loss was largely an accounting adjustment, not an operational meltdown, but it clearly indicates challenges in realizing the full value of that significant strategic investment.
Got it. Even cash flow, usually a strong point for robust businesses like this, seems to have weakened significantly in 2025.
It has. Operating cash flow in the first half of the year dropped sharply, from SEK 434 million in H1 2024 down to SEK 220 million in H1 2025.
Almost cut in half. What are the implications of that for a company needing to fund these aggressive growth strategies you mentioned?
Well, a substantial drop in operating cash flow like that definitely reduces a company's financial flexibility. It could potentially limit its ability to fund future investments organically or pay down debt as quickly. And capital efficiency metrics like return on equity or ROE, they also reflect these challenges.
How so?
While ROE recovered to 3.9% in 2024 from the negative figure in 2023 again, distorted by that impairment charge, it's still well below historical highs, like the 14.8% ROE they achieved back in 2020. This indicates that their capital deployment, particularly that big eGenomics acquisition, isn't yielding the same returns it once did, at least not in the short term. That's a key area for management to address.
So let's zoom in on these headwinds. What's causing this perfect storm, this turbulent period, for a company that otherwise seems to have such a strong foundation?
The most significant and immediate financial risk has definitely been severe currency headwinds. It's a major factor for any global company, but particularly for Vitrolife reporting in SEK. A strengthening krona just directly reduces reported sales and profits when translating foreign earnings back home.
Just mathematically unavoidable.
Pretty much. In Q2 2025 alone, currency movements reduced reported sales by a massive 8 percentage points. That's SEK 73 million wiped off the top line just from FX. They've even quantified the sensitivity. A hypothetical 10% change in SEK against major currencies would impact pre-tax income by roughly SEK 141 million based on 2024 volumes. That's substantial.
Wow. Okay, currency is huge. What else?
Beyond currency, we also see macroeconomic and geopolitical factors playing a significant role. The APAC market slowdown is a key concern. The post-COVID recovery of IVF cycles in China, a massive potential market, has been slower than expected. That led to flat organic growth in APAC in Q2 2025.
Why the slowdown in China?
Often tied to broader economic uncertainties within the region, consumer confidence, discretionary medical spending can fluctuate quite a bit.
Then there's the U.S. regulatory uncertainty you mentioned.
Right. In the first half of 2025, the political discourse around IVF access in the U.S., including that presidential executive order in February, created significant market uncertainty. Management directly attributed a significant drop in cycles in the Americas to this resulting cautiousness among patients and clinics.
So even the talk of potential changes had an impact.
Exactly. It highlights how sensitive the fertility market is to public sentiment and political rhetoric, even without actual laws changing immediately. Patients hesitate, clinics advise caution, and cycle volumes drop.
And the Middle East conflict.
Can't ignore that either.
Mm-hmm.
Ongoing geopolitical instability there has had a direct negative impact on the genetics business within the EAA region. In areas affected by conflict, healthcare services, especially those seen as less immediate, like fertility treatments and genetic testing, can see sharp declines. Resources get diverted, patient access becomes constrained. This just compounds the challenges in that already underperforming genetics segment.
So it really is a perfect storm of external factors, many of them quite unpredictable.
But are there internal or operational challenges contributing as well, or is it solely external forces?
Oh, absolutely. Beyond the currency and geopolitics, there are definitely operational and segment-specific challenges. We've already discussed the significant margin compression. It's not just currency, it's also rising supply chain costs. Global logistics have been messy, and that conscious increase in operating expenses to fund strategic investments, like building out the U.S. commercial team, all these contribute to that sharp EBITDA margin collapse.
And the persistent underperformance in genetics?
Exactly. That segment continues to be a drag. It raises serious questions, given the substantial capital invested in its acquisition and its strategic importance for that unbroken chain vision. Its struggles impact the overall profitability and growth story, demanding a clear turnaround strategy from management.
And all this is happening during a leadership change. What's particularly challenging is that these headwinds are unfolding during a period of management and strategic transition. A new CEO, Bronwyn Brophy O'Connor, took the helm, and an acting CFO, Helena Wennerstrom, was appointed in late 2024. This new leadership team is tasked not only with navigating these acute, largely external headwinds, but also with simultaneously executing a new, ambitious 5-year strategy.
Talk about pressure.
Exactly. It adds another layer of complexity. They have to stabilize the ship while simultaneously charting a new course forward. Not easy.
Despite these turbulent times, companies like Vitrolife don't simply stand still, right? They're clearly looking to the future, making strategic bets on where the market is heading, what's their long-term vision, how are they planning to grow out of this period of financial headwinds.
The central pillar of their long-term strategy is Quite a significant and ambitious transformation, becoming a provider of a fully integrated, digitally connected platform for the IVF clinic.
Moving beyond just products.
Exactly. It's not just about selling individual products anymore. It's about creating an entire ecosystem that streamlines every aspect of the IVF workflow. The aim is to address critical clinic needs for automation, standardization, workflow efficiency, in a field that is still, surprisingly, quite manual and heavily dependent on individual expertise.
So digitization is key.
Digitization and integration. This digital transformation is key to scaling operations and improving consistency across clinics.
And the eFertility acquisition fits into this.
Absolutely critical here. The acquisition of the Dutch software company eFertility in May 2024, EUR 9.6 million upfront, potential earnouts, is the linchpin. It provides specialized clinic management software, things like their eWitness system for electronic traceability of gametes and embryos.
Making sure everything matches the right patient. Crucial.
Absolutely crucial. And their eBase electronic medical record, or EMR, platform for comprehensive patient data management. This acquisition gives Vitrolife that missing digital component to knit together their overall offerings, moving them from just a collection of products to a truly integrated solution provider.
So the goal is to weave eFertility's software with Vitrolife's existing hardware, like the EmbryoScope, their consumables, their AI tools like IDAScore, creating this seamless, data-rich ecosystem covering everything from patient intake to cryopreservation.
That's the vision.
Here's where it gets genuinely transformative, it seems to me. If successful, this could significantly increase switching costs for customers, right? Logging them deeper into the Vitrolife ecosystem because their entire operation would run on this platform.
Deeper lock-in.
And it would also create new high-margin software as a service, or SaaS, revenue streams. Those are highly prized by investors. Could potentially justify a much higher valuation for the company in the long run. That's a potential game changer if it works.
That's certainly the ambition, and the potential reward is substantial. However, the execution risk is equally substantial.
Always catch.
Always. It requires seamless technical integration of disparate systems, always a monumental challenge, especially across different regulatory environments, different clinic IT infrastructures. And critically, it requires overcoming the inherent conservatism of clinical customers, getting them to adopt new digital workflows, change established practices.
Clinics can be slow to change,
Yeah.
especially with sensitive procedures.
Exactly. The clinical community tends to be very cautious about anything that might impact patient outcomes or disrupt meticulously validated protocols. Moving from paper tracking to an electronic witness system, that's a huge cultural shift, needs extensive training. The success of this platform strategy is arguably the most important determinant of Vitrolife's long-term value creation. If they pull it off, it's truly a game changer. If not, it represents a significant investment with potentially limited return.
Beyond the digital platform, innovation clearly remains a key growth driver, crucial for staying ahead in this rapidly advancing field. What's in their R&D pipeline? What kind of new scientific solutions can we expect that will directly benefit patients and clinics?
Well, they're focused on high-impact solutions, things designed to improve both clinical outcomes for patients and operational efficiency within clinics. A significant area is the further development of artificial intelligence-based tools for embryo selection, building on the success of IDAScore.
Making selection more objective.
Exactly, making it more objective, reducing variability, potentially improving live birth rates by identifying the most viable embryos more accurately and consistently.
What else is cooking in R&D?
They're also heavily invested in non-invasive testing.
Yeah.
This includes advancing non-invasive PGTA, like their Embrace test. This analyzes the culture media the embryo grew in, instead of requiring an invasive embryo biopsy.
Why is that better? Less risk to the embryo.
Precisely. It minimizes any potential risk to the fragile embryo from a biopsy procedure, offers a safer, less disruptive method of genetic screening. Highly desirable for patient safety and comfort.
Makes sense. Anything else stand out?
Automation is another key focus. Their lead investment in Auto IVF, a biotech startup, signals a clear commitment to developing next-gen solutions for automating lab processes.
Taking the manual work out.
Yeah, helping clinics scale operations, reduce manual labor errors, address staffing shortages, increase overall efficiency, could really transform the day-to-day of an embryology lab. And finally, they continue consumables enhancement. Ongoing research to improve the efficacy of their culture media, transfer solutions like embryo glue. These improvements are directly aimed at increasing live birth rates by providing optimal conditions for gametes and embryos, making every step more effective.
It's clear they're investing heavily in the future, both digitally and scientifically. But beyond these innovations, where are they looking to expand geographically? Are there particular markets they're targeting for significant growth?
Indeed. The United States is a top priority. It's recognized as the world's largest IVF market by value and a region where Vitrolife sees significant untapped potential.
So they're doubling down on the U.S.
They're making deliberate, planned investments in their U.S. sales and marketing organization to accelerate growth, capture greater market share from competitors, more feet on the ground, more direct engagement, tailoring offerings to the American market.
And China. You mentioned challenges there earlier, but it's still a focus.
China is another critical strategic focus, yes. Vitrolife is planning to establish local manufacturing capabilities there.
Why local manufacturing?
Two main reasons. One, to de-risk its supply chain from geopolitical tensions, a very real concern for global businesses today. Two, to better position the company to benefit from potential new government reimbursement policies for fertility treatments in China. If the Chinese government starts subsidizing or covering IVF more broadly, local manufacturing could give Vitrolife a significant competitive edge in accessing that enormous market.
Interesting. And what about market share generally?
What's also notable, and speaks volumes about their competitive strength, is that management has indicated their growth, especially in consumables, is being driven by market share gains, not just underlying market growth.
Even with market slowdowns.
Particularly true in APAC, where Vitrolife's products are performing well even amidst that slower-than-expected recovery in overall IVF cycle volumes. This demonstrates strong competitive execution. It shows their integrated solutions and brand reputation are resonating, allowing them to outperform the market even in challenging conditions.
All of this ambition, the digital platform, the R&D, the international expansion, it all requires significant investment. How do they fund all this? What's their overall capital allocation strategy during these turbulent times? Seems like a balancing act.
It is. They prioritize a balanced approach, which is crucial right now. They fund organic growth through internal R&D, spent SEK $117 million in FY 2024. They also strategically pursue acquisitions like eFertility to expand capabilities and market reach, fill those critical gaps. And importantly, they commit to providing returns to shareholders through a consistent dividend policy, signals financial discipline and confidence.
How's their balance sheet looking? Flexible?
They maintain a conservative capital structure, which provides substantial financial flexibility, a real asset when facing uncertainty. Their net debt to EBITDA ratio was a very comfortable 0.8x in Q2 2025, well below their target of less than 3.0x.
Plenty headroom there.
Plenty. This strong balance sheet allows room to maneuver. And to further enhance this position, ensure liquidity, they completed a major refinancing in July 2025. Secured a new EUR 300 million loan agreement. Includes both a term loan for existing debt and a flexible revolving credit facility for future initiatives. Gives them a strong financial runway.
And dividends. You mentioned they're still paying those.
Regarding shareholder returns, yes. Their policy aims for an annual dividend around 30% of net profit after tax. For 2024, they proposed SEK 1.0 per share, which is actually a 10% increase from 2023.
An increase, even with the headwinds.
Yes. That increase, even in a year with challenging reported growth and profitability, signals management's confidence in the company's long-term cash-generating ability and their commitment to shareholder value, despite the near-term headwinds. They also have authorization for share buybacks, though none were executed in 2024. Seems like internal investment and dividends are the priority right now.
This deep dive has truly revealed a company with incredibly strong fundamentals, operating right at the heart of a high-growth market.
Yeah.
But also battling some serious near-term challenges. It really presents a fascinating investment conundrum, doesn't it?
It certainly does, a classic case study.
Let's look at the two sides of the coin, the bull case and the bear case for Vitrolife. But first, how does their current valuation stack up in light of everything we've discussed? Where does it stand now?
Well, historically, Vitrolife commanded a significant premium valuation, reflected its market leadership, robust growth, its enterprise value to revenue, or EV revenue, multiple hit a peak of almost 46x in late 2021.
46 times revenue. Wow.
Yeah, when growth was accelerating, optimism was sky high. That multiple has since compressed considerably, stabilized around 8.0 by 8.5x in 2023-2024, but it's currently sitting around 5.5x on a last 12 months or LTM basis.
Okay, so a big drop from the peak. What about earnings multiple?
Its trailing price to earnings, or PE, is about 40.4x. Now, that's high in absolute terms for many industries, but it's actually lower than its own historical 5-year average. Suggests the stock has already seen a significant re-rating downwards by the market.
How does it look compared to peers like Cooper Surgical?
That's what's particularly striking when we compare it to direct competitors like Cooper Companies, the parent of Cooper Surgical. Cooper Companies trades at about 4.2x LTM EV revenue and 14.0x LTM EBITDA. The premium Vitrolife once commanded has eroded significantly.
So the gap is narrow.
It has. And what's more, and this is a critical point, Vitrolife's Q2 2025 EBITDA margin of 27.8% is now below Cooper Surgical's LTM EBITDA margin of 30%.
Profitability now lower than a key competitor.
Right. This raises a critical question about whether its current premium, even at these reduced levels, is justified by its recent performance, especially given that its profitability is, at least temporarily, lower than a key peer providing a similar integrated offering.
Okay, so a valuation that's come down still holds some premium, but profitability has dipped below a key competitor. For the optimists, the bulls in this scenario, what's the strong argument for Vitrolife? Why should investors be looking at this company with a glass-half-full perspective despite the recent challenges?
The bull case really boils down to taking that long-term perspective, urging investors to look beyond the current noise, the temporary headwinds. You're investing in a market leader, right? In a genuinely structural growth market.
The RT market itself.
Exactly. Powered by non-discretionary demographic tailwinds, rising infertility, delayed parenthood, evolving family structures. These are fundamental, enduring forces, not fads. They'll continue to drive demand for decades, providing strong underlying current for Vitrolife's business.
Okay, strong market is point one.
Secondly, they possess durable competitive advantages. We've talked about them. Technological leadership with EmbryoScope, strong brand reputation built on quality and trust, that integrated portfolio creating incredibly high switching costs. These moats are very real, actively protect their market position, makes them hard to dislodge.
Moats are intact.
Yes.
What else?
There's also a compelling strategic vision. That ambitious pivot to an integrated digital platform, hardware, consumables, AI software could fundamentally transform the business. If successful, it could create entirely new, higher margin recurring revenues from software, further solidify customer relationships, embed Vitrolife even deeper, potentially justifying a much higher valuation in the long run.
The digital transformation potential.
Huge potential. Finally, the current headwinds are largely seen by bulls as temporary. Mostly cyclical, like economic slowdowns hitting capex, or event-driven, like currency swings, geopolitical issues, regulatory uncertainty. As these factors normalize, currencies stabilize, macro concerns ease, political clarity emerges, the underlying earnings power and robust organic growth potential should shine through. Creates potential for a significant re-rating of the stock back towards its historical premium.
On the flip side, what worries the skeptics? The bears. What's the bear case for Vitrolife, highlighting the risks and downsides that might outweigh that long-term potential?
The bear case points directly and understandably to the material erosion of profitability. That sharp collapse in the EBITDA margin, down to 27.8% in Q2 2025, is a serious concern. It's driven by both external currency factors and internal operational costs and strategic spending.
And the risk is it's not temporary.
The risk here is that this margin compression could be more structural than temporary, meaning even as headwinds ease, the company's profitability profile going forward might be permanently lower than what investors historically expected or what management has targeted. That would be a major problem for the valuation.
Okay, margin risk is key. What else worries the bears?
There's also significant execution risk with that ambitious digital platform strategy. Transforming into a tech-enabled platform provider is complex. If they struggle with technical integration, commercial execution, or just getting conservative clinics to adopt these new digital workflows, it could jeopardize this crucial strategic initiative, render the capital invested in e-fertility and other digital efforts with limited return.
The platform strategy might just not work out.
It's a real risk. Another concern is the persistent weakness in key segments. The continued underperformance of genetics, acquired for a significant price, raises questions about capital allocation, management's ability to handle its diverse portfolio effectively. And the recent slowdown in the high-growth technology segment is also a red flag. Shows even core products aren't immune to market pressures.
So segment performance issues.
Right. And finally, at its current valuation, even with the multiple compression, the remaining premium relative to peers might not adequately compensate investors for these significant near-term risks to earnings and the execution risks around the long-term strategy. If profitability doesn't rebound quickly and sustainably, that premium could continue to erode, leading to further downside for the stock.
So if you, the listener, are watching this company, whether you lean bull or bear, what should you be looking for? What are the key catalysts and metrics to monitor to understand which way this story is heading in the coming quarters?
Okay, key things to watch. The most critical financial metric is definitely the EBITDA margin. A clear, sustained recovery back towards that 30-33% target range. That would be a strong bullish signal. Shows headwinds are fading or management's actions are working. Continued weakness below 30%. Lends more credence to the bear case, suggests deeper issues.
Margin recovery is number one.
Number one. You should also focus on organic growth in constant currency. Track the underlying organic growth rate of each business segment, stripping out those volatile currency effects. Gives the clearest picture of business momentum. Look for re-acceleration in technologies, which is sensitive to clinic capex, and crucially, stabilization or a return to growth in genetics. That needs to stop being a drag.
Watch the underlying growth ex currency. Got it.
For the long-term vision, monitor platform strategy adoption. Any quantitative or qualitative commentary from management about cross-selling a fertility software into their EmbryoScope base or the number of clinics adopting the integrated platform, those will be key indicators of success. Are those high-margin SaaS revenues materializing?
Track the digital rollout. Makes sense.
Pay attention to regional performance. Evidence of a sustained recovery in IVF cycle volumes in the strategically vital U.S. and China markets is crucial for hitting overall growth targets. These markets represent immense potential. Their recovery is vital, and of course, the direction of currency markets. The strength or weakness of the Swedish krona versus the euro and dollar will remain a major external variable influencing reported results in the near term. Keep an eye on FX rates. Hashtag TechTag had outro.
So we've taken a deep dive into Vitrolife AB, a company operating right at that profound intersection of critical medical technology and, well, that powerful, deeply human desire to have a healthy baby.
Fascinating space.
We've seen a robust market, a strong competitive moat built on decades of innovation and strategic integration, but also, undeniably, a company grappling with significant financial and geopolitical challenges that are testing its resilience, testing its leadership right now.
This deep dive really highlights that constant tension so many businesses face, doesn't it? Balancing ambitious long-term strategic transformation in Vitrolife's case, this massive pivot to a digital platform with acute short-term operational and market pressures like currency headwinds, geopolitical instability.
Real balancing act.
Vitrolife's journey will undoubtedly be a fascinating case study in how a market leader adapts to a rapidly changing, often unpredictable global environment, all while trying to fulfill such a profound and deeply personal human need.
This leaves us with a thought, perhaps for you, the listener, to mull over. In an industry as sensitive and critical as reproductive health, how much weight should be given to temporary market volatility and external shocks, things that seem so immediate and impactful? How much weight versus the long-term fundamental demographic shifts shaping patient demand and that enduring human dream of having a healthy baby?
That's a tough question. How do you weigh the short term versus the very long term?
And how truly transformative will a company's ability to digitize and automate be? Not just for its own business model, its own profitability, but also for the very delicate, personal, and profoundly impactful process of creating life itself, giving hope to so many.
It could change everything, or be harder than expected.
It's definitely a journey and a question worth watching closely.
Yeah.